You know that feeling, right? That moment you're staring down a mountain of information,
Yeah.
especially when it's for something really high stakes like an exam.
hmm
It's not just about memorizing facts, is it? It's about understanding the nuances, the why behind the what.
Absolutely.
Today, we're really going to try and cut through that information overload, give you a clear, actionable path to mastering a critical area in financial reporting, the review engagement.
That's right. And especially for those of you gearing up for case-based exams, this deep dive is, well, it's custom tailored. We want to help you not just comprehend, but really internalize the standards on review engagements.
We're talking SRE 2400 and SRE 2410 specifically.
Exactly. SRE 2400, that's for when the practitioner isn't the auditor.
Mm-hmm.
And SRE 2410, that's when the review is done by the entity's independent auditor. We're going to break these down, look at how they work in the real world, and really arm you with the precise terminology and insights you need.
For those tricky exam scenarios.
Precisely. Think of this as your shortcut to being exceptionally well-informed.
Okay, and to do that, we've gathered quite a stack of sources. There's a detailed chapter on review of financial information. We've got direct excerpts from the SRE 2400 and 2410 standards themselves.
And even insights from expert commentary. We've sifted through it all to pull out the most important nuggets of knowledge for you.
And we'll be using the precise language, the exact terminology from these sources.
Yeah.
That's key, right? Getting familiar with how these ideas are actually expressed in the standards.
It's crucial, both for truly understanding the concepts and for nailing those exam responses.
All right, let's dive in. We can maybe unpack this with a scenario, something that might feel pretty familiar if you're studying right now.
Good idea.
Let's talk about Madhulika. She's a CA final student, and she's facing her first big assignment, a review of quarterly results for a listed company, Track Data Limited.
Okay.
And here's an interesting wrinkle. Her firm is also the statutory auditor for this company.
So that immediately points towards SRE 2410 being relevant. Interesting.
Exactly. And she's grappling with some really fundamental questions. Questions that honestly set the stage perfectly for our whole discussion today.
Right. What's on her mind?
Well, basic stuff, but crucial. Like, what is the core difference between an audit and a review? Why is a review even mandated by the regulator, in this case, probably SEBI, for a listed company in India?
Good questions.
Does it involve the same procedures as an audit? If not, what kind of procedures are used? How do you gather evidence? Are the responsibilities similar for the accountant?
Yeah, the practicalities.
And really importantly, what's the objective? What are you trying to achieve? And what happens reporting-wise if you find misstatements?
Excellent. These are exactly the questions we need to tackle. We'll address every single one of Madhulika's points as we go through this.
Great. So let's start with her first point. What exactly is a review?
Okay, fundamentally, a review is classified as a limited assurance engagement. That's the key phrase right there, limited assurance.
And that's a big contrast with an audit, right?
Precisely. An audit, which follows the standards on auditing, aims to provide reasonable assurance. Think of that as a high level of assurance. You're trying to reduce the risk of a material misstatement going undetected down to an acceptably low level.
Okay. High levels for an audit.
But a review provides a lower level of assurance. That's the limited assurance bit. It means, quite simply, fewer procedures are performed compared to an audit. Less extensive work.
Got it. Like you said, maybe a quick health check versus a full MRI.
That's a decent analogy, yeah. Both give information, but the depth and certainty are very different.
So if it's lower assurance, what's the official objective stated in the standards?
The objective is for the practitioner, the accountant doing the review, to express a conclusion. And that conclusion is designed to enhance the degree of confidence of intended users regarding the preparation of an entity's financial statements in accordance with an applicable financial reporting framework.
Enhance confidence. But it's based on limited assurance.
Exactly. The conclusion is explicitly based on obtaining limited assurance. It adds credibility, yes, but not the same degree of credibility as a full audit opinion.
Right. And to get that limited assurance, the core procedures are mainly, what was it, inquiry and analytical procedures.
Spot on. Primarily inquiry and analytical procedures. These are done to get sufficient and appropriate evidence, enough evidence to support that limited assurance conclusion.
So less deep diving into individual transactions, not typically doing physical checks like in an audit, more asking questions and looking for patterns or anomalies.
That's the essence of it. You're asking management questions, you're looking at financial data, comparing periods, looking for unusual fluctuations. That's the analytical side.
And Madhulika's other question, why are these reviews even done? Especially, why are they mandated?
Great question. There are two main drivers. First, legal and regulatory requirements, like Matulika's scenario with Track Data Limited, a listed company. Regulations, often from securities regulators like SEBI in India or the SEC in the US, mandate quarterly reviews for listed entities.
Right, SEBI, the Securities and Exchange Board of India. So for listed companies, it's about providing investors with quicker updates between the big annual audits.
Exactly. It gives the market some level of assurance more frequently without the time and cost of a full audit every quarter. It strikes a balance.
But it's not just mandatory reviews, is it? Companies might do them voluntarily.
Absolutely, that's the second driver. Reviews can be really useful for other reasons, maybe for private contracts or to support getting a bank loan. The bank might want a review rather than a full audit, or just for internal governance.
So it's a more flexible, maybe more cost-effective option in some cases.
It can be. It provides a degree of credibility without going the whole 9 yards of an audit. It meets a specific need for assurance, which might not require the reasonable level.
Okay, makes sense. A middle ground. So let's really dig into the first standard, SRE 2400. This is the one for engagements to review historical financial statements. And crucially, this applies when the practitioner is not the company's auditor, right?
That's the key differentiator for SRE 2400. It specifically covers the practitioner's responsibilities when they don't have that ongoing audit relationship.
Got it. So under 2400, what's the main goal?
The primary objective is, again, to get that limited assurance, specifically about whether the financial statements as a whole are free from material misstatement. And then, of course, to report and communicate as the standard requires. It's about providing that moderate comfort level.
Even with limited assurance, the foundations have to be solid. Ethics, quality control. Those are still front and center.
Absolutely critical. The standard is very clear. The practitioner shall comply with relevant ethical requirements, including those pertaining to independence.
Independence is still key, even if it's just a review.
Definitely. Independence safeguards your ability to be objective, to form an unbiased conclusion. It maintains integrity and professional skepticism. Think about it, if you're not independent, how can users trust your conclusion even if it's limited assurance?
Good point. It's the bedrock.
It really is. And building on that, the standard puts responsibility on the engagement partner. They are responsible for overall quality of each review engagement.
So overseeing everything. Planning, supervision, making sure the report is right.
Yes, exactly. Direction, supervision, planning, performance, and signing off that the report is appropriate for the circumstances. It mirrors the quality control principles we see across all assurance work. Consistency and reliability are paramount.
And two concepts that always come up: professional skepticism and professional judgment. They're just as important here.
Indispensable. The practitioner shall plan and perform the engagement with professional skepticism. That means having a questioning mind, being alert to conditions that might indicate misstatement.
So not taking everything at face value.
Precisely. It includes questioning inconsistencies and investigating contradictory evidence. You can't just accept management's answers if they seem odd or conflict with other information you have. It's about being actively analytical, not cynical, but curious.
Like if revenue jumps unexpectedly, you don't just say great quarter.
Exactly. You ask why. What changed? Were there unusual deals? Could revenue be recognized incorrectly? Skepticism means probing beneath the surface. It helps avoid overlooking red flags.
And professional judgment.
Hand in hand with skepticism. The practitioner shall exercise professional judgment throughout the review, making informed decisions based on their knowledge and experience, especially when it comes to things like materiality, what's significant enough to matter, and evaluating the evidence gathered. That judgment is what makes us professional.
Okay. Before you even agree to do the review, there are hoops to jump through. Acceptance and continuance. SRE 2400 talks about reasons not to accept an engagement, right? Unless the law forces you to.
Yes, there are specific grounds for non-acceptance. A big one is if there's no rational purpose for the engagement.
What does no rational purpose look like in practice?
Well, maybe management imposes a significant scope limitation right from the start, making it impossible to actually perform a meaningful review. Or you suspect they just want your name associated with potentially dodgy financials to give them a veneer of legitimacy. That's inappropriate association.
Okay, that makes sense. Other reasons.
If you can't meet ethical requirements, especially independence, that's a non-starter. Or if you anticipate that the information you need won't be available or reliable, can't do a review without information.
What about management themselves?
Huge factor. If you have cause to doubt management's integrity to the point where you think it would affect your ability to do the job properly, you shouldn't accept. Trust is fundamental.
And if they try to limit the scope up front in a way that guarantees you'd have to issue a disclaimer.
That's another reason not to accept. Why start an engagement you already know you can't complete properly?
So those are reasons to say no. What about the positive side? What must be in place before you can say yes? The preconditions for acceptance.
Right. There are preconditions. First, the financial reporting framework they're using, like IFRS or US GAAP or Indian GAAP, must be acceptable. It needs to be a proper basis for preparing the statements.
Makes sense. And the big one is about management's responsibilities.
Absolutely critical. Management must acknowledge and understand its responsibilities. This isn't just box ticking. They need to confirm they're responsible for. 1, preparing the financial statements fairly, free from material misstatement, whether due to fraud or error.
Okay, preparation is their job.
2, designing and maintaining the internal controls necessary for that preparation. Controls help prevent or detect misstatements.
Right. And 3.
3, providing the practitioner with full access. Access to all relevant information records, documents, everything. And crucially, unrestricted access to people within the entity that the practitioner needs to talk to for evidence. No stonewalling allowed.
The implications seem huge. If these aren't met, and management won't budge.
Then the practitioner shall not accept the proposed engagement. Full stop. Unless, again, law or regulation forces them to.
And if you are forced to accept under those circumstances.
Then you shouldn't make any reference to SRA 2400 in your report. It signals to the reader that the engagement was compromised, that it didn't meet the standards requirements.
It's a very strong signal.
Okay.
So assuming you accept, all the terms need to be agreed in writing.
Yes. All agreed terms shall be recorded in an engagement letter or other suitable form of written agreement before the review starts.
The engagement letter, always important.
Absolutely. It sets out the objective, the scope, management's responsibilities again, the framework being used. And importantly, it usually includes a statement that the actual report might look different from what's expected if circumstances change during the review. It manages expectations on both sides, prevents misunderstandings.
Right, lays the groundwork clearly. Okay, so SRE 2400 sets the stage carefully. Once you're in, engagement letter signed, how do you actually perform the review? Let's get into the how-to. Starts with materiality.
It does. The practitioner shall determine materiality for the financial statements as a whole. This is for designing your procedures and evaluating the results you find.
And is materiality different for a review versus an audit?
This is a key point. The judgment about what level is material is the same regardless of the level of assurance obtained. A $1 million misstatement is still $1 million, whether you find it in an audit or a review. What changes are the procedures you use to look for it and the level of certainty you get.
So the threshold doesn't change, just the work done.
Yeah.
And you have to revisit materiality if things change during the review.
Yes, materiality must be revised if new information comes up that changes your initial assessment.
Okay, then you need to understand the company.
Yeah.
Obtaining understanding.
Yeah.
Why is this still important in a limited scope review?
It's vital because understanding the entity, its environment, the industry, the accounting framework, all that helps you identify areas where material misstatements are likely to arise. Even with fewer procedures, you need to focus them effectively.
Know where the potential problems are lurking.
Exactly. It's a continual dynamic process. Your understanding evolves as you learn more. Maybe they launched a new product line that brings new risks you need to consider. Without that context, your inquiries might be too generic.
Right. Now, the core procedures. Designing and performing procedures. We said inquiry and analytical procedures. Let's break down inquiry first.
Inquiry is fundamental. It's about seeking information from management and other persons within the entity. Asking questions.
What kinds of questions?
All sorts. How are estimates made? Are there related party transactions? Any significant or unusual deals? Any known fraud or illegal acts? What happened after the balance sheet date, subsequent events? How's the going concern assessment looking? Any major commitments? Non-cash transactions? It's broad.
But it's not just asking, is it? You have to evaluate the answers.
Critically important. You need to evaluate the responses. Use your professional skepticism. Are the answers reasonable? Do they make sense? Are they consistent with other information you have? Can you corroborate them somehow? A vague or evasive answer is a potential red flag.
Okay. And the other main tool, analytical procedures. What's involved there?
Designing these means first checking if the underlying data is actually reliable enough to analyze. Then you use them to identify inconsistencies or variances from expected trends, values, or norms.
Like comparing this quarter's gross margin to last quarter's or to industry averages.
Exactly. Or looking at relationships between financial data, like sales and receivables. If sales plummet but receivables barely move, that might warrant inquiry. These procedures can corroborate information from inquiries, or they might flag unexpected things that need further inquiry.
And the methods can be simple or complex.
Yes, they can range from simple comparisons to performing complex analysis using statistical techniques, depending on the circumstances and the data available.
SRE 2400 also calls out procedures for specific circumstances, like related parties. What do you do there?
You need to stay alert for any undisclosed relationships or transactions. And if you identify related party transactions, you inquire about their nature, the business rationale, who is involved. These often need closer scrutiny because they might not be at arm's length.
And if you suspect fraud or noncompliance with laws?
If indications pop up, you communicate them to the appropriate level of management or those charged with governance, like the audit committee. You assess the potential impact on the financials and figure out if you have any external reporting duties, maybe to regulators.
What about going concern? Assessing if the company can stay afloat.
If you see events or conditions that may cast significant doubt on their ability to continue as a going concern, maybe big losses, negative cash flows, losing a key customer, you must inquire about management's plans to deal with it. Are those plans feasible? And is the situation, the material uncertainty, adequately disclosed in the financial statements? Users need to know about that risk.
Okay, this next one feels really important, especially for showing a review isn't just superficial. Additional procedures for potential misstatements. What happens if something smells fishy?
This is critical. If the practitioner becomes aware of a matter that causes the practitioner to believe the financial statements may be materially misstated, you can't just stop there. You must design and perform additional procedures.
More work.
Yes, sufficient additional procedures to allow you to conclude one of two things. Either that the matter is not likely to cause the financials to be materially misstated, or that it does cause them to be materially misstated.
So you have to resolve the
You
uncertainty.
have to resolve it. It's an iterative process. You keep digging until you can reach one of those conclusions. If you can't get enough evidence to conclude either way, maybe management blocks you or the info isn't there, then you have a scope limitation. That directly impacts your report. This shows a review has teeth. You have to follow up on potential problems.
Good to know. What about subsequent events, things happening after the balance sheet date but before you issue your report?
If events occur during that period that require adjustment or disclosure in the financials, the practitioner shall request management to correct those misstatements.
And if management refuses, especially if you've already given them the report draft,
If they refuse to amend the statements after you've provided the report, you shall notify management and those charged with governance not to issue the financial statements to third parties. That's a serious step.
and if they issue them anyway,
Then the practitioner shall take appropriate action to seek to prevent reliance on their report. This could involve consulting lawyers, notifying regulators. It can get complicated, but you can't let a misleading report stand under your name.
wow, okay. Finally, under SRE 2400 performance, written representations. These are important evidence.
Yes, they're an important source of evidence. Management must provide written representations.
What do they have to represent in writing?
They acknowledge their responsibilities for the financials, internal controls, providing access, just like in the preconditions. They also have to specifically confirm things like they've disclosed all known related party transactions, any known fraud or noncompliance. Their assessment of going concern is appropriate. They've told you about all significant subsequent events, commitments, non-monetary transactions.
And if they refuse to provide these written reps,
Big red flag. You have to reevaluate their integrity. And it likely means you haven't obtained sufficient appropriate evidence, which could lead to a disclaimer of conclusion or even withdrawing from the engagement. If they won't put it in writing, it casts serious doubt.
okay, so SRE 2400 is pretty comprehensive for reviews where you're not the auditor. Now let's switch gears to SRE 2410. This is review of interim financial information performed by the independent auditor of the entity. This is Madhulika's exact scenario, right? Her firm is the auditor doing the quarterly review.
Precisely. The scope of SRE 2410 is key. It applies when the review of interim financials is done by the entity's independent auditor. This is crucial because that auditor already has a deep understanding of the entity from the annual audit.
That existing relationship must make a difference.
Huge difference. It streamlines the whole process. They aren't starting from scratch trying to understand the business and its risks.
So the objective under 2410 is slightly different.
The wording is specific to enable the auditor to express a conclusion on whether anything has come to the auditor's attention that causes the auditor to believe that the interim financial information is not prepared, in all material respects, in accordance with an applicable financial reporting framework. Again, that negative assurance.
And the goal is risk reduction, but to what level?
The auditor performs procedures to reduce to a moderate level the risk of expressing an inappropriate conclusion when the interim financial information is materially misstated. Moderate level, consistent with limited assurance.
And we need to keep hammering this home. Contrast with an audit.
Absolutely. The standard explicitly says a review, in contrast to an audit, is not designed to obtain reasonable assurance that the interim financial information is free from material misstatement. Procedures are primarily inquiries and analytical procedures. You're not doing the extensive testing, inspection, observation, confirmation that you do in an annual audit.
So it might miss things an audit would catch.
It might. A review can bring significant matters to light, but it doesn't provide all the evidence an audit would. It's designed for timeliness and relevance for interim reporting, like quarterly results. Speed is often a factor.
A key part of SRE 2410 seems to be leveraging that existing knowledge. The auditor updates this understanding, right? How does that work?
Yes, instead of building understanding from zero, they update what they know from the annual audit. They also need to get a sufficient understanding of internal control as it relates to preparing interim financial information, which might differ slightly from annual controls.
What kind of procedures help with that updating?
They'd consider significant risks found in prior audits, like risks of management overriding controls. They'd read the latest annual statements and the comparable interim period from the prior year. They'd think about materiality specifically for the interim period.
Materiality might be different for a quarter versus a whole year.
It could be, quantitatively and qualitatively. They'd also look at misstatements found in prior periods, corrected or uncorrected. They inquire about fraud risks, any big changes in the business or internal controls, and how the interim financials are actually put together. It leverages their history with the client.
So the inquiries, analytical, and other review procedures under 2400, similar types of procedures as 2400, but informed by that audit background.
Exactly. Procedures are still ordinarily limited to making inquiries and applying analytical and other review procedures, not usually inspection, observation, confirmation.
What specific things might they inquire about in an interim review?
Things like, have counting principles changed? Any uncorrected misstatements hanging over from last time? Any unusual events like business combinations or disposals? How are fair value assumptions holding up? Any new related party deals? Big changes in commitments or contingencies? Are they complying with debt covenants? Any significant transactions right near the end of the quarter?
And asking about fraud again.
Yes, asking management about their knowledge of any actual suspected or alleged fraud or noncompliance. It's about focusing on what could likely go wrong in this specific interim period.
How is going concern handled under SRE 2410?
If events arise casting doubt, the auditor inquires about management's updated assessment. Have things changed since the last annual assessment? What are their plans now? And is the disclosure in the interim financials adequate? Things can change quickly between annual audits.
In evaluating misstatements found during the review.
The auditor must evaluate them individually and in the aggregate. Are the uncorrected misstatements added together material to the interim financial information? It's the overall picture that matters.
Management representations still needed under 2410.
Yes, written representations are required, covering similar ground. Management's responsibility for controls and preparing the interim info, confirmation that uncorrected misstatements are immaterial, disclosure of fraud, non-compliance, subsequent events. It's crucial evidence.
What about accompanying information, like the MD&A section that often comes with quarterly reports?
The auditor has a responsibility to read that other information to look for material inconsistencies with the interim financial information they reviewed.
And if they find an inconsistency, say the MD&A says profits soared, but the numbers show a loss.
If there's a material inconsistency and it's the interim financials that need correcting and management refuses, it impacts the review report. If it's the other information, like the MD&A, that's wrong and management won't fix it, the auditor might have to describe the inconsistency in their report or even consider withholding the report or withdrawing.
Communication is key. What if the auditor finds something needing a material adjustment?
They must communicate it as soon as practicable to the appropriate level of management, and often to those charged with governance, like the audit committee as well, needs timely attention.
And if management or the governance body doesn't respond properly, like CA-CRAT in that case study?
This is where SRE 2410 gets serious. If they don't respond appropriately within a reasonable period, the auditor should consider modifying the report.
Qualified or adverse conclusion?
Depending on the situation, yes. But it goes further. They should also consider the possibility of withdrawing from the engagement, if that's legally permitted.
And even potentially resigning from the annual audit.
Yes, consider resigning from the appointment to audit the annual financial statements. If management ignores a material issue in an interim review, it raises fundamental questions about their integrity and the reliability of information they might provide for the annual audit. It signals a serious breakdown.
Okay, let's circle back to Matulika's first big question because it's so foundational. Audit versus review. We need to nail this distinction.
Absolutely. It's the cornerstone. Let's recap the key differences clearly.
Number one, level of assurance.
Audit. Reasonable assurance. High level. Low risk of undetected material misstatement. Think maybe 95% confidence, metaphorically speaking. Review. Limited assurance. Lower level. Moderate risk reduction. More like, we didn't see anything obviously wrong.
Number two, nature and extent of procedures.
Audit. Performs elaborate and extensive procedures, includes tests of controls, substantive procedures like detailed testing of transactions and balances, inspection, observation, confirmation, deep dive, review. Performs fewer procedures, primarily focusing on inquiry and analytical procedures. Ordinarily doesn't require testing records through inspection, observation, confirmation. More high-level checks, asking questions, looking at trends.
Number three, nature of conclusion.
Audit. Provides an assurance opinion, positively worded. Give a true and fair view, or present fairly in all material respects. A definite statement of assurance. Review. Provides an assurance conclusion. Negatively worded. Nothing has come to our attention that causes us to believe that the financial statements are not prepared in all material respects. A statement about what wasn't found.
And number four, evidence gathering.
Both aim for sufficient appropriate evidence, but the amount and type of evidence differ significantly. For a review, you need enough evidence to support that limited negative assurance conclusion, but not the extensive evidence needed for a positive audit opinion. It's about proportionality.
Crystal clear. Okay, let's move to the output, the review report. What does it actually look like? What are the standard contents?
Okay. The report structure is quite defined. It must have a title, clearly stating Independent Practitioner's Review Report. No ambiguity there.
Addressed to.
The addressee, as required by the engagement, often shareholders or the board of directors for a company.
Then an intro.
Yes, the introductory paragraph. It identifies exactly which financial statements were reviewed. For G, balance sheet, income statement for the quarter ended X, refers to the accounting policies used, and states clearly that they have been reviewed.
Then it clarifies who's responsible for what.
Exactly. A section on management's responsibility explains that management is responsible for preparing the financials fairly and for the internal controls needed to do that. Sets the context about the statements are their statements.
Followed by the practitioner's responsibility.
Right. Practitioner responsibility describes their job to express a conclusion based on the review, referencing the specific standard used. SRE 2400 or 2410. Crucially, it states it's a limited assurance engagement, that the procedures are substantially less in scope than an audit, and therefore no audit opinion is expressed. Managing expectations is key here.
Okay, and the core conclusion.
That's in the conclusion paragraph. This is where the negative assurance statement typically go.
Any other standard bits?
Yes, there's usually a reference to compliance with ethical obligations, including independence. The date of report, which can't be earlier than when sufficient appropriate evidence was obtained, and the signature, the practitioner's name, firm registration, membership number, and nowadays, often a UDIN.
That unique document identification number, like a digital fingerprint for authenticity.
Exactly. Adds traceability and helps combat fraudulent documents.
Okay, now the different flavors of conclusion. Unmodified versus modified. When do you get the standard, clean, unmodified conclusion?
That's issued when, after doing the review, nothing has come to the practitioner's attention that causes them to believe that the financial statements are not prepared, in all material respects, in accordance with the applicable financial reporting framework. That's the ideal outcome.
And the precise wording is important for exams.
Very. For a fair presentation framework like IFRS, it's typically based on our review, nothing has come to our attention that causes us to believe that the financial statements do not give a true and fair view or do not present fairly in all material respects. For a compliance framework, it's slightly different. Nothing has come to our attention that causes us to believe that the financial statements are not prepared in all material respects in accordance with the framework. You need to know these phrases.
Got it. Now, when does it get modified? This is where the complexity comes in.
Modification happens for two main reasons. One, the practitioner finds the financial statements are materially misstated, errors, omissions. Two, the practitioner was unable to obtain sufficient and appropriate evidence about material items, a scope limitation.
Okay, let's take material misstatements first. How do you decide between a qualified conclusion and an adverse conclusion?
It depends on how serious the misstatement is. If the effects are material but not pervasive, you issue a qualified conclusion. Pervasive means it's so fundamental or widespread, it affects the understanding of the financials as a whole.
So qualified is like mostly okay, except for this one specific thing.
Kind of. The wording would be something like, based on our review, except for the effects of the matter described in the basis for qualified conclusion paragraph. But if the effects are both material and pervasive, it's much worse. That requires an adverse conclusion.
An adverse means the whole picture is misleading.
Essentially, yes. The phrasing becomes, based on our review, due to the significance of the matter described in the basis for adverse conclusion paragraph, the financial statements do not give a true and fair view, or are not prepared in all material respects. It's a strong statement that the financials are fundamentally flawed.
And in both qualified and adverse cases, you knew a separate paragraph explaining why.
Absolutely. A basis for qualified adverse conclusion paragraph is mandatory. It has to describe the misstatement and, if possible, quantify its financial effect, or explain if required information wasn't disclosed. Full transparency.
Okay, now the second reason for modification. Inability to obtain sufficient appropriate evidence. A scope limitation. Same logic. Qualified versus something worse.
Similar logic, yes. If the possible effects of undetected misstatements, because you couldn't get the evidence, could be material but not pervasive, you issue a qualified conclusion.
The wording reflects the uncertainty.
Exactly. It's like, based on our review, except for the possible effects of the matter described in the basis for qualified conclusion paragraph, nothing has come to our attention that causes us to believe. It signals, we couldn't check this bit, but the rest seems okay.
And if the potential impact of what you couldn't check is really significant, material and pervasive,
Then you issue a disclaimer of conclusion. The report explicitly states you couldn't get the evidence, and therefore, the practitioner does not express a conclusion on the financial statements.
basically saying, we couldn't do the job properly, so we offer no assurance.
Precisely. It's the most severe form. Again, you need a basis for disclaimer of conclusion paragraph explaining why you couldn't get the evidence. And remember, if management imposes a scope limitation after you started, and its effects would be material and pervasive, you generally have to withdraw, if legally possible. You can't disclaim under those circumstances if withdrawal is an option.
One more paragraph type, the emphasis of matter paragraph. This one's different because it doesn't modify the conclusion itself.
Correct. It's used to highlight something that is already appropriately presented or disclosed in the financial statements, but is so important that it's fundamental to users' understanding. A classic example is a material uncertainty related to going concern that has been adequately disclosed by management.
So it's like pointing a big flashing arrow at a specific note in the financials.
Exactly. It draws attention without qualifying the conclusion. The paragraph refers directly to the relevant note. It says, look here, this is important, without implying anything is wrong with the presentation.
And if there are other legal or regulatory reporting requirements.
Those are handled in a separate section, usually titled Report on Other Legal and Regulatory Requirements. Keeps them distinct from the conclusion on the financial statements themselves.
Okay, we've covered a ton of theory from the standards. Let's make it real. Time for applications, case studies. Let's bring it all together and revisit Madhulika. How can we answer her questions now?
Great idea. Let's tackle them one by one, using the precise language we've discussed.
Her first one, difference between audit and review.
The core difference is the level of assurance. Audit provides reasonable assurance, high level, while review provides limited assurance, lower level. Fundamentally different confidence levels for users.
Same procedures as an audit. If no, which ones?
Definitely no. A review relies primarily on inquiry and analytical procedures. much less extensive than the elaborate procedures of an audit, which include tests of controls and substantive testing like inspection and confirmation.
Is sufficient appropriate evidence gathered too?
Yes, but it's sufficient appropriate evidence to support limited assurance. The quantity and type of evidence are tailored to that lower level, enough for a negative conclusion, not a positive opinion.
Are responsibilities similar to an audit?
Shared responsibilities include ethics, skepticism, judgment. But the scope of responsibility in a review is limited to expressing that negative conclusion based on SRE 24000002410, not giving an opinion on true and fair view like an audit. The standards define the specific limited responsibilities.
And finally, reporting requirements if misstatements aren't corrected.
If material misstatements identified during the review aren't corrected, the practitioner must issue a modified conclusion, either qualified or adverse, depending on materiality and pervasiveness. And the conclusion remains negatively worded, highlighting the uncorrected issue in the basis paragraph. You don't just ignore it. Okay, let's try case study 2, the fire incident. Company has a major fire, big uninsured losses. But critically, it's appropriately disclosed in the interim financials.
Right, so management did their job on disclosure. But the fire obviously
Raises events or conditions that may cast significant doubt about the going concern assumption. Big time. Since the disclosure is adequate, the auditor doing the review under SRE 2410 shouldn't qualify the conclusion. Instead, they should add an emphasis of matter paragraph.
to highlight that material uncertainty.
Exactly, pointing users to the note describing the fire's impact and the going concern uncertainty without changing the nothing has come to our attention conclusion itself.
Got it. Now, case study 3, uncorrected material adjustment. CA CROT finds a material adjustment needed in a quarterly review, tells management, tells the audit committee, gets crickets. No response.
A tough but realistic scenario. What are her options under SRE 2410?
Well, first, that lack of response to a material issue is a huge red flag. She almost certainly needs to modify the report.
Qualified or adverse, depending on the misstatement's impact.
Yes, but it doesn't stop there, does it? Given the lack of response.
No, it escalates. She must consider the possibility of withdrawing from the engagement if that's legally an option. If management is unresponsive on something material, it can undermine the whole review.
And even consider resigning from the annual audit.
Absolutely. Consider the possibility of resigning from the appointment to audit the annual financial statements. This inaction raises serious questions about management integrity and the reliability of the whole control environment. It could make a proper annual audit impossible. It's a very serious implication.
Okay, final challenge. The integrated case study. Fast Operations Limited. Incomplete draft review report for a listed company. Compulsory SEBI review. Let's fill in the blanks.
All right, let's test our knowledge.
First blank. Addressee. XXXX. Who should it be addressed to?
For a listed company under compulsory review, the most appropriate addressee is typically the board of directors. They have the ultimate oversight responsibility.
Makes sense. Next, paragraph 2. Our responsibility XXXX. How should that read?
The correct phrasing is, our responsibility is to express a conclusion on the statement based on our review. Emphasize conclusion and review, not opinion, not reasonable assurance.
Crucial distinction. Okay, paragraph 3. Engagement standard, which SRE applies here. Listed company, interim review performed by the independent auditor.
That clearly points to SRE 2410, review of interim financial information performed by the independent auditor of the entity because they are the auditor. If they weren't, it would be SRE 2400.
Got it. Last one, paragraph 4, the conclusion phrasing for an unmodified conclusion. What's the magic negative assurance wording?
It should be. Nothing has come to our attention that causes us to believe that the accompanying statement has disclosed the information required, or that it does not contain any material misstatement. That standard negative assurance phrase is key.
Perfect. Okay, wow. We've really covered the landscape of review engagements. From the basic definitions, distinguishing them clearly from audits, digging into the specifics of SRE 2400 and SRE 2410.
Looking at ethical requirements, acceptance, procedures like inquiry and analysis, handling misstatements, scope limitations.
And nailing down the exact structure and wording of the review report, including all those modifications. And we saw how it plays out in practical scenarios like Madalika's and the case studies.
Hopefully this deep dive has done more than just prepare you for exam success by demystifying these standards. It should also give you a toolkit for looking at financial information more critically in general.
Yeah, equipping you to spot what matters, ask the right questions, and really interpret financial reports with a much sharper eye, whether that's for an exam or just understanding business information better.
You're better armed now to understand the nuances of limited assurance.
So let's leave our listeners with a final thought, something to mull over.
Okay.
In this world of, ever faster information, rapid change, and interconnected markets,
Hmm.
where does the future of limited assurance actually lie? We see this demand for quick, timely insights, but they still need to be reliable.
It's real tension.
How might this demand continue to shape the role of professional accountants? Could we see a shift maybe beyond just the traditional audit towards more agile, perhaps more frequent forms of assurance like reviews, or even something entirely new? What does assurance look like in the future?
That's a fascinating question. How do we balance speed, cost, and the level of confidence users need in a dynamic world? Something definitely worth thinking about.